Good afternoon, and welcome to our January market and industry update. It appears I may be experiencing some video lag, so I don't know if you're getting that. Maybe drop that in the comments. Let me know if there's a big lag on the video. If there is, maybe I'll reconnect. Welcome, Dave. Welcome, Z. What is up? We got two categories we're going to touch on today. So we're going to talk a little bit about market stats. There's just not all that much to say. There's a couple things that are worth pointing out, but overall, not a ton. We're going to touch on that. Then we're going to talk a little bit about some of the national monetary policy as well, because there's some changes coming up to where they thought things were going to head. You know, they being the official they. So we're going to talk about both of those things. I'll keep an eye on the chat. I have to toggle back and forth a little bit. Someday I'll figure out how to do a screen share while I'm doing this video. That might be a while before I figure that out. But in the meantime, you'll have to rely on my words. What is up, Rob, Angela? Nice to see everybody. Happy New Year. Happy New Year. Your New Year present, your New Year gift, is record low housing inventory. Yes, I'm not sure if you see that as a gift or not, but we're going to talk to you about why that is a gift. It's actually fewer homes for sale that are available right now in our MLS than there ever have been as far as records go back. The number as of right now is 15,426. Without context, that doesn't mean a whole lot, but 15,000 and change. For reference, at the end of November, there was a little over 20,000. That's like a 25% drop month over month. Here's another weird kind of stat for perspective on that. Think back to October 2020. It was like 6 months after the original shutdowns and everything. The market had certainly already gotten tight, if you recall. Right now, there's half the number of homes there were in October of 2020 for sale. Half. And that compares to, for example, the prior, if we were using October, there's a third of the number of homes that were available in 2019 at that time. So your low inventory woes have not gone away. In fact, they've gotten even tighter, and we're now at record lows considerably below the last or the next lowest month, which would have been, you had this May and this March. We're at about 20,000, just under 20,000, and we're now a little over 15. So that is an important data point. It's not the only data point that matters, but it is an important one. The inventory is now at record lows. So you're looking for sound bites for your clients. That's one of them. Housing inventory in our area is now at a record low. Now, new listings have also been light, but not by anywhere near as much of a margin. You're at about 8,000 from December, which is a little below. You're averaging more about 9,000 each December the years prior. So it's about a 15% drop in new listings that have come on. It's nothing like the 57% drop in inventory that's available. So new listings are not that scarce. December is always the lowest month of the year for new listings, in case you're wondering. Year in and year out, it's always way lower than the other months. This year it was a little bit lower than prior years, but not dramatically. Here's an interesting stat for you though. The number of new listings that came on the market in 2021 was virtually identical to the number of new listings that came on the market in 2020. Identical. Both years you were at about 214,000 and change. They're within 300 of each other. So there's been the same number of homes listed this year at 2021 as there was the prior year. And that's only about 9% below 2019. We've been saying this all along, and I'll say it again. There's not a shortage of new listings. That means if you're a listing agent, there's not a shortage of business to get. That means if you're a buyer agent prospecting for listings, there's not a shortage of new listings to get. There's not. There is a shortage of homes available because there's been all this excess demand for 2 years at this point, and all the new listings that come on are instantly gobbled up. So there is a shortage of available homes, and that's a challenge for buyers. There's not a challenge for sellers. I just shared with you, record low housing inventory. As far as contracts go, things have been holding steady. You're a little bit above last year. We're still about 25% above the year before. So that's been consistent all year. That contracts have been about 25% above where they were in 2019. But the gap has started to narrow, or it's continued narrowing compared to 2020. There's not much news in the contracts department. And closed sales are up by about the same amount, 25% over a normal year. So all that is okay. The things that I would really focus on for you when you're having your conversations with clients, housing inventory is now at a record low, lower than it has ever been, and considerably lower than even the next lowest month. That's a big data point. I would also continue to reinforce that there is not a shortage of new listings. There's just a shortage of available inventory. That is an important point as well. Shaken says buyer surplus with new generation spending money now. Absolutely. And so far, no signs of changing. We all know it will change. We're not being the, Pollyanna and all this stuff. It will change. It's not showing signs of changing yet. The other thing that we look at a lot is months of housing supply. And when I look at months of housing supply, that's also at a record low when you take a look at our entire MLS. It's down to 1.2 months. So housing supply, the quick explanation for those that I maybe haven't explained this to you before, or you didn't remember it from real estate licensing school. Housing supply, that stat, is where you take the total number of homes available, the whole pile of houses over here, and over here you've got buyers writing contracts and closing those homes, gobbling those homes up. You divide one into the other. Say, how many months would it take at this pace of buyers to gobble up all the existing inventory? That number is at a record low right now, 1.2 months. So if new homes stopped coming on the market, it would take 1.2 months for every listing in the MLS to be gone. 6 months is considered a balanced market. We're nowhere near it, and it'll take a while for us to get back there. So again, record low inventory, not record low new listings, record low housing supply, no signs of changing yet. Okay, that's the real estate stats, market stats update. Do those who are tuned in have any questions about that right now? Before we go into the industry section, I wanted to give you some sound bites. I think I gave those to you. Any questions, comments, or reflections? Going once, going twice. Sold. Next up is our industry update. So let's talk about because this is the financial market, and that does have an impact on the real estate market, although it's not usually a direct impact. So first of all, what happened is last month at the Federal Reserve's meeting, they changed the plan. There are things that they were planning on, things that they were projecting for years out, and last month's Fed meeting, they were like, we're changing that. And when the Fed changes its outlook, it changes everything. It's a whole ripple effect. So if you go back into, when COVID first hit, one of the things that the Fed started doing is buying bonds. I'm not going to get super deep on this, but it's important that you know what it's doing. When the Federal Reserve buys bonds, they're printing money and injecting money into the economy by purchasing bonds. So they're throwing money into the economy and taking bonds out. Obviously, that puts more money into circulation, and that gives people more money. It also causes inflation. But when the economy is really in a fragile state, they want to juice it up, and so they want to inject it with cash. And they did that back in the recession. They did a massive wave of bond buying back then. They tapered it off. Back then it was called quantitative easing when they started tapering that off. And as recently as November, they had continued to announce plans for when they were going to start tapering their bond buying. Well, in December, they said they were actually going to cut that time frame in half. So they're like, whoa, we're going to dial back the bond buying at double the rate we were going to dial it back just a month ago, because inflation's gotten crazy out of control. I think everybody has felt that. And so they're going to be done altogether buying bonds in March. They will no longer be buying bonds in March. So that'll make a difference in the flow of money, a difference in inflation. At that same time, they plan to begin raising interest rates. Now, understand that's the federal funds target rate, not mortgage rates directly. These things are all related, but they don't control mortgage rates. What that is a change is they were saying previously they were going to keep interest rates low probably through the end of 2022 into 2023, and letting the economy run hot, injecting money, keeping rates low. It's gotten out of hand. So now they're going to dial back that bond buying, and they're going to raise rates more frequently and higher than they previously said. So how much do you say? If you rewind back to September, half of the Fed officials believed that they would not be raising rates at all until 2023. Now, most of them are projecting at least 3 rate increases in 2022. That's a big change. So you're going to see the federal government and the Federal Reserve, I should say. It's not necessarily the government per se. You're going to see the Federal Reserve really try to put the brakes on the overheated economic stuff that's going on. What's that going to do to other rates? Yeah, there's going to be a ripple effect where it's going to cause mortgage rates to go up. We know that. But a lot of the free and available cash that's been getting printed and put out there is going to stop coming into the economy. Now, the Fed didn't say they were going to go sell, $7 trillion worth of bonds and go suck that money back out of the economy. They're not saying that, but they're going to stop injecting it in. So you should see the rate of economic growth slow down. The cost of living, the wage increases, you should see that stuff all slow down. Maybe starting soon, for sure, starting in about March. Is that going to have a dramatic direct effect on housing prices? No. But it should have a modifier effect on housing prices and the nature of the market. So hopefully that'll at least get back from 1.2 months of supply. Maybe we'll end up back at 3 months of supply. I mean, that would actually ease the market quite a bit for a lot of the buyers out there. So hopefully I didn't get too nerdy on you there with the Fed talk, but those things do absolutely have an impact on our clients, on what's happening with our clients' money, our clients' employment, our clients' economic outlooks for themselves and their family. Yeah, that's the industry update that I've got for you. What questions do you have? Shaken says, list now, buy now, right? So, I mean, there's opportunities for anybody. Honestly, I'm still looking to pick up another investment property as long as I can go get a ridiculously low interest rate. I can lock in my cost of ownership. My rents have gone up on my rental properties. I think it's still a good time to do that. But at the same time, it's a good time to sell because the rate of growth should slow. It should slow based on what they're saying. Won't this decrease the wild amount of offers and overbidding with cash to close appraisal gaps? It should mitigate that a little bit. Understand though, it's not mortgage rates that drives home buying behavior. That's a modifier. Nobody ever said mortgage rates are low, I should buy a house. No, they buy houses because they have a need to buy houses. It's household formation and household destruction, right? It's birth, death, marriage, divorce, job relocation, career changes, whether that be upward or downward. Those are the things that cause people to buy homes. Mortgage rates help them be able to pay more for homes. So, they can throw an extra 10 or 15 grand at it. Yes. But that it won't take people off the table other than people that are really borderline. So you're still going to have a lot of buyers out there. A lot is going to need to change, and I think it's going to take a while to get back to where we're looking at a balanced market, going from 1.2 months of supply all the way to 5 or 6. So I don't think these monetary changes at the federal level are going to do that. I think they're going to they should soften that a bit, but that's not single-handedly going to take all those the 25% increase in buyers off the table. That's my personal opinion on that one, but that's anybody's guess. What other questions, reflections? Hopefully this is valuable and you can get a couple of things you can go and talk to your clients, educate your clients. There's some great data on nationwide historical housing prices on the St. Louis Fed website. They publish some good data that you can look at there. And that's where I got a lot of this information. There's also on that website, there's a rate chart that tracks the federal funds rate against mortgage rates, so you can see that they're related, but they're not lockstep. So that's something you might want to take a look at, is the federal funds rate versus mortgage rates. Shagan says the inflation along with higher rates should lower the fence buyers' debt-to-income ratio down. Yes, people that are on the fence, fast forward a couple months, anytime housing supply is below 6 months, you're going to see housing prices increasing at a rate beyond inflation. And so people that are on the fence right now, 3 months from now, the prices will be higher. Likely the rates will be at least a little bit higher. They will be off the fence and back in their own yard. That will definitely happen. Z, thanks for your comment. I'm glad this has been helpful. I'll give it a final little opening here. How much do you think rates will increase? It's really tough. I mean, you go ask a bunch of experts about what they expect to happen with mortgage rates, and mortgage rates are determined by a market. They're not set by anybody. They are formed in response to primarily the 10-year Treasury bill, because it's a competitive product when institutional investors are looking to buy investments with their money. Mortgage-backed securities tend to offer a similar rate of return and a similar amount of risk compared to a 10-year T-bill. And the 10-year T-bill is market-based, based on people's projections of the economy. So there's this whole little interaction that happens. You can't predict how much mortgage rates are going to go up, not accurately at least. What I can tell you is that however fast they were going to go up, it's probably going to be a little faster now. I don't think anybody was saying they were going to go up really fast. You're not going to be looking at 6% mortgages next year. That's not going to happen. But people are still getting mortgages all over the 3s right now, and it's probably likely that you won't be seeing 3s anymore. You might be seeing 4s. You might be even approaching 5. But to come up from in the 3s to over 5 would be a really, really big, fast stretch. I would be skeptical of an increase that much, but I'm not an expert, so we'll have to stay tuned and see what the effects are on the overall economy, the T-bills, the bond markets. That'll impact mortgage rates, but they're going to go up. Any other questions? Final auction for questions going once, going twice. Drum roll. Thank you, everybody, for dropping in, taking a few minutes, and getting some of these sound bites. If you need any more data sources information, go to the St. Louis Fed, go to InfoSparks in the MLS for your real estate data. Check in with anyone on the Market Center leadership team. We can help you out. Thank you very much. Have a great day. Happy New Year.